Alright everyone, I'm back. It's been a while since I made a video, a few weeks or so. So this video here is to show you how we invested to reach financial independence. I got a little new setup here, so I'm going to debut it. Of course, we got the PowerPoint presentation, some interactive links which I'll go over. So let's go ahead and get started. Like I said, I'm a newbie YouTuber. What we're going to talk about today is the 401k contributions, the limits, the pre-tax Roth, after-tax IRA accounts, how we invested to reach financial independence, our asset allocations, and then a few book recommendations. So with investing accounts, you have your workplace retirement plans. Mainly I worked at companies that had their own retirement plans. So a lot of those were, for myself and my wife, were 401k, 403, and 457 plans. We also had IRAs. We had Roth IRAs, and then you have your normal investing brokerage accounts. Those are just mainly after-tax accounts that you would put in after you do the other two. For 2025, the limits for the workplace retirement account is 23,500, and then an additional 7,500 for those over 50 for pre-tax and Roth. Those two share the same bucket. And then there's a total limit of 70,000 for 2025, which includes the employer match and after tax. There's not many plans that offer this after tax. A lot of people get it confused with a Roth, but it's a totally different bucket of money. There's three buckets of money. So like I said, there's pre-tax and Roth. Those two share the 23,500 if you're under 50 years old. Then you have the employer match, whatever your company matches you, and then you have the after-tax bucket. And about 50% of the plans offer this type of contribution. Some places call it over a spillover plan, and some just call it an after-tax. So if you do all those things, you could put up to 70,000 a year. And I've been doing that for the past few years. So obviously, if you want to retire early, you need to, increase your income, lower your expenses, so you have that difference that you can invest and have it work for you. And then you have your IRA, which stands for individual retirement account. There's a $7,000 limit for those under 50 and 8,000 for those under 50. You and if you have a spouse, you and your spouse could put 7,000 each as long as you make at least 7,000 a year. If if you make 14,000 a year, you can put 7,000 and your wife can have 7,000 even if she or he doesn't have a job. And then there's a Roth limit, a Roth IRA limit. So for those that have a modified adjusted gross income of 150 if you're single, it begins to phase out. You can't do a Roth. You have to do another method called a backdoor Roth. And then if you're married, as long as you make under 246,000, you can have a Roth IRA. So how we invested. Early on in our career, we were maxing out our 401ks, putting at least whatever the IRS max is. Back then it was, for me, it was around 13,500. And if you think about it today in 2025, it's 23,500. We also put money into our IRAs. In the beginning, um, we didn't have the technology that we have today. I'm going to show you like hands-on some of the tools that you can use today. But early on, I basically had a 90% stock, 10% bond allocation. So it's not like I had any special foresight or crystal ball. I stuck with ETFs, low-cost funds that are in the 401k, and mainly did that. As you build your nest egg and you get closer to your financial independence target, you're thinking about leaving, you don't want to be as risky. So then what I did was, a transition to the Pinwheel portfolio, and late last year I found out about this golden ratio portfolio, which I'll show you about. And I'll take you to Portfolio Visualizer to show you how you can use these tools to analyze what you have and what some good recommendations currently are. I learned a lot of this stuff reading the Facebook groups and listening to podcasts. And if I were to do it all over, I wouldn't do a 90% stock, 10% bond. I would do what I'll show you now. So I already entered a lot of this information in Portfolio Visualizer. I can send you the link. There's a link here that I'll put in the PowerPoint slides and show you, but this is the 50/50 large cap growth, small cap value portfolio, which is recommended by Frank Vasquez, and I'll show you why in a minute. And what the large cap growth is, that's mainly your larger growth companies like your Nvidias and Facebooks and things like that. Then your small cap or your smaller companies that have a lot of value. So the reason why I would suggest these things, these portfolios is, like I mentioned earlier in my career, I had the 90%, 10% stock bond allocation. So the way this website works is you can enter different portfolios and analyze their outcomes and the data and such. So if you enter in the 90%, 10% allocation, if you start off with 10,000, after it does this analysis for, I can't remember if it was, let's see here. If you started, for example, in 2016, 10,000 in 2016, as of 2025, it'd be worth 27,000 for this fund right here. So, so it does some analysis to see, I think around 10 years worth of data or so, and it will show you that. That's what I had in the beginning. Frank Vasquez, he has a podcast. He also created or imagined or created this golden ratio portfolio, which is featured on portfolios charts, which I'll show in a minute. Um, he said this was a really good one. And he said, do your own testing. So I entered the data in, and it shows that, like, if you're early on in your career or in your journey, you want, pretty good growth. Um, you can afford, if the market drops or whatever, you have time. But if you're closer to retirement, you wouldn't want that type of portfolio because you need to protect your nest egg. So currently, since, we're not working, and I don't think we plan to. We're with this golden ratio, and I'll show you why in a moment. But you can also compare it to what I had early on in my career until I transitioned to the golden ratio. You can compare it to the S&P 500 index, and then you can also compare it to what he recommends for someone starting out. So you start out with 10,000 invested. At the end of the timeline of the analysis, it shows 36,000. Here, the S&P 500, it shows 38,000. But, you know, you could do that, but there's other articles showcasing why you wouldn't want to do that. I don't think I'll show it in this video, but maybe another video. And some of these is cumulative annual growth rate, shows those numbers. It shows the standard deviation, shows the best year, shows the worst year, um, the maximum drawdowns, things of that nature. I'll take a minute right here to pause. The S&P 500 does do better than the 50/50 large cap growth, small cap value. The reason why I mentioned this is because the large cap growth has the larger companies in there, and then the small companies that have a value um, opportunity in them, whereas the S&P 500 is just whatever's in the S&P 500. It's the largest 500 companies. I wanted that just like in early on in my career, I was looking at charts and how different asset allocations performed. And of course, 100% stocks would perform better than a 90%, 10% allocation. You can clearly see it on this sheet right here. But what it offers is less volatility, and that's what I was looking for when early on in my career. I didn't want to see, big jumps. I was like, okay, I think at the time it was like maybe 9% long-term growth for S&P 500 all stocks versus 8%. And I was willing to, give up some performance for a smoother curve. Just like right now, I'm in the golden ratio. It obviously doesn't perform anywhere close to the large cap growth and small cap value or the S&P 500, but what it offers is a smooth return, stronger safe withdrawal rate, which I'll show you. And like I said, this is a back test of past data. We don't know what will happen in the future. Uh, we can only go, and I'm comfortable with this. I'm comfortable that I made the best decision that I was comfortable with the information that I had using past data. It could change, it could be totally wrong in the future, but at that point, I know that I was comfortable with my decision. So the golden ratio, the reason why I pick it now for, someone that's not planning on working or, starting their drawdown phase is because of what it offers. This is the portfolios charts website. The creator of the website, he analyzed a lot of portfolios. He has a lot of data sets that he analyzed, and some of these portfolios is what Ivy Leagues use to control their endowment. See, even still today, the golden ratio is not the highest performer based on all his metrics. But for me, I like it because it's number one on the safe withdrawal rate. It has a good standard deviation. It has a good Ulcer index. Ulcer index is a measure of how deep a portfolio draws down and how long it takes to recover in a downturn. Um, Based on all these outcomes, that's why I picked the golden ratio. Just like when I did the 90-10, just like why I suggest the 50-50, large cap growth, small cap value versus just all S&P 500, because I like what it has. It has 21% large cap growth, 21% small cap value, 26% long-term bonds, 16% gold, 10% commodities, which I'm using REITs, and then 6% as a short-term treasury cash holding. Like this article said, like I mentioned earlier, you know, this website talks about Frank, and I'll put this in the PowerPoint as well. He's very knowledgeable, so that's why I picked that allocation. So that's a little bit of that quote unquote hands-on. I'll put the links here. Here are two of the links and information on the golden ratio portfolio. And then some of the book resources, like I usually conclude with, that I've either read or listened to. I like this book, Work Less, Live More, New Way to Retire by Bob Clayett. Simple Path to Wealth. Simple Path to Wealth. That's by J.O. Collins. He recently updated. I think I saw a post that he's doing a sale for Amazon Day Prime Days. And then I really enjoyed The Richest Man in Babylon book. Talks a lot about wealth and things of that nature. So that concludes this video. Thanks everyone.